Welcome back, dividend growth and value investors. I am European dividend growth investor. In today's video, I'm going to briefly share with you the importance of picking stocks with strong fundamentals, especially during these volatile times and especially coupled with high inflation. After that, I will actually show you 3 examples of such dividend growth stocks that currently really spot strong fundamentals, and it's even more evidenced by the recent earnings from this week. But before we get started, guys, let's remind ourselves why we are dividend investors. I started in 2014. I started really on the journey of dividend growth investing with buying my first stock, McDonald's at the time. Don't ask me why. I decided to sell it again in 2016. But look at this graph. It is really compounding at work. How am I doing this? Just dollar cost averaging. Every month, I'm able to save 50% of my salary and it goes directly into dividend growth stocks. I still have a little bit of money on the sidelines on top of that from bonuses that I received over the last 2 years, but I aim to deploy them in the upcoming months when there are more and more opportunities, as actually where we are today in the stock market. Because where we are today is really interesting, because one of the leading indicators that I often look at is the Shiller PE ratio. I like this ratio a lot because what it's doing, it's taking the current S&P 500 value and dividing it by the 10-year average earnings from those companies listed in the index. Currently, it stands at 27. This is really high. The average is around 15 or 16, so that's about here. And you can see it even touched it briefly in 2008 and it went back there. This, of course, is all because of a zero interest environment that we have experienced over the last 2 decades, but now it's really different because we are currently having an interest rate of 4 to 5% already. So this goes really quickly, and maybe time will tell us, of course, this is going to drop way further. But if we just look at the normal PE ratio at the moment for the S&P 500, it looks much better. It's currently at a PE trading of 19.5, so 15 is really not that far off anymore. If this would happen, this would mean another decline of 20% or something like that. I really don't see that unlikely. But guys, to move on, what really inspired me today for this video was an awesome visual infographic from Visual Capitalist, because what is important here during market uncertainty as we're experiencing right now is to focus on fundamentals. Which are the fundamentals that they look into? Earnings growth, dividends, and return on invested capital. Actually, these are also 3 things that I always look at when I'm analyzing companies. So we're pretty much aligned here. And what I also liked here really to see is over the last 2 decades, dividends have outpaced inflation. So yes, we are in a really high inflationary environment right now, but in the long run, I truly believe that dividends beat inflation. Of course, this is not a chart of the 70s, so it might look a little bit different. Also, if you start today, you might not feel it like that. But I am pretty convinced that 20 years from now, your dividends will have done much better than the inflation. And where can you get that today? There's really an environment of TINA. There is no alternative. Pension funds, saving accounts, bonds, nothing will get you there. So I still believe that the stock market is the best way to share and create wealth, and dividends is such a welcome hard cash income that not many other assets are providing, maybe real estate as an example. Now, what is important then also for me during these kinds of times, and I found this chart really interesting from Hartford Funds, is if you look at the historically high probability of beating inflating sectors, we're talking about energy, equity, right, but also consumer staples, utilities, healthcare, industrials. So what I'm going to show you now are 3 examples of stocks, in my opinion, that really show these strong fundamentals and should be able to actually, with a high probability, beat inflation. So the first stock that I would like to talk about is Procter Gamble. Who doesn't know Procter Gamble? Specifically in Europe, I can't imagine that you don't know one of the billion-dollar brands like Ariel, Draft, and some of the others that we have. Huggies, I believe, Bounty, Always. Come on, if you're a guy who isn't married to a wife or doesn't have a girlfriend that uses Always from time to time, right? So this is really an iconic brand, a consumer staple, big rival of Unilever. We know how Unilever performed over the last 10 years almost. It went nowhere. But Procter & Gamble has been growing really hard. And what I really liked in last week's earnings was that they were able to spot an organic sales of 7%, Remember, this is a high inflation environment. Sales, of course, needs to also turn into earnings, right? But let me start here. The company returned nearly 6.3 billion of cash to shareholders, 2.3 billion in dividend and 4 billion in common stock repurchases. So they're still rewarding shareholders massively during these times. If we look here at the core EPS, actually they say there was a decline of 2%. However, they're actually quite, how you say it, not being fair to themselves, I would say, because if you take the currency into account, then they were up to 7% because, of course, the dollar was strengthening, but otherwise they would have been up 7%. Now, come on. I know we are talking here about 10% in the US or something like that inflation. Unfortunately, Poland 16%, but this is really something that I consider as a really, really good earnings report. The share action was relatively mild based on these earnings, but for me they were really strong because look at it, 9% of the earnings increase came from higher pricing. This really tells us that they have pricing power. 1% only increase from positive product mix and 3% decrease in shipment volumes. So they are able really to outpace, how you said, decline in volumes with price hikes at the benefit of the company, and therefore to be able to grow their EPS with 7% currency neutral. This is awesome. So what does my dashboard tell me then? If we look at Procter Gamble, the dividend is safe. 60 to 80 is a safe dividend. 80 to 100 is a very safe dividend. Why 66? Because the average free cash flow growth could have been a bit higher. That's why it gets a bit of less points. Also, when we look at the payout ratio, it really punishes companies above 60%. So I'm a bit harsh in this. However, this is also based on learnings. But look at this balance sheet, an AA3 credit rating, right? And if you don't remember what this means, let me show you. AA3 is a high grade. These are really solid balance sheets. You really shouldn't lie awake from that if we only look at the balance sheet here. So, other than that, debt equity shows that interest coverage 41%. Look at this, 66 years of dividend growth over time and 6.4% 5-year annualized dividend growth. This is really good. If we then look at the analysis, now what stands out here straight away is that there is still an issue with the valuation, right? Price to earnings 22, forward PE is 22. But let's remember what they were saying right here. Earnings growth, dividends, return on invested capital. So if we go back here, what we can see, earnings growth over the last 5 years, almost 10%. Dividend growth, like I mentioned, 6%. And the value creation metric here. So this is the return on invested capital minus the weighted average cost of capital. So what is their return minus what it has costed? The difference here is 14%. This is a true compounder and a real example of a compounder that you want to have in your portfolio with these kinds of metrics. Yes, there is a value issue because if we look at that, right, if we take the current free cash flow of an estimate of 13.6 billion at a growth rate of, let's say, 6%, in line with the, let's say, dividend growth that we saw over the last 5 years, 4% thereafter, and a discount rate of 10% and a multiple of 16%. We're talking about a fair value of 92. However, I believe that there's a high likelihood that they will be able to continue to grow with 8%. We just saw it in their currency neutral EPS numbers of 7%. If they would be doing this, their terminal multiple deserves to be a bit higher at 18%, and we will be talking about the stock that is worth at a fair value of $109. I can tell you, I have a buy order there around $110. I don't want to save on the $1.66 here, so at 110 I will buy a little bit more of this, at least initiating a position. I would go really full into it at around $90. I don't think we will see it anytime soon there. It would still require a 15% decline from where it is today. In current markets, I think this is possible. So in my opinion, Procter & Gamble is really such an exemplary stock that you want to own during an inflationary environment, during a crisis, because they are able with these strong fundamentals to continue growing their earnings, and we've seen that in the latest report. Hey guys, a really quick commercial break. I'll promise you, I'll keep it short. I'm currently on 77% of the 500 euros I need to visit my buddy Engineer My Freedom, with who I'm hosting the Dividend Talk podcast. We've never seen each other in person yet, and we would love to meet each other. So if you want to contribute to that, please buy me a coffee. I would really like to call out some people that have recently done that. Thank you, Sebastian Bode, so much. Povilas, Mr. HLDV, Anne, GD Muriel, Dermot GMAC, Frits Schuurman, someone, Sender, John, Alex, and Many Mystery, and B.A. Shu, and Mark. Thank you so much for buying me a coffee and supporting us on this journey. This live podcast is going to be awesome, hopefully still in December. Okay then, the second stock that I would like to talk about is ASML. If you don't know what ASML is the world's leading manufacturer of chip making equipment. So no, they don't produce chips, but they produce and manufacture the lithography machines that are an essential component in chip manufacturing. So effectively the machines. And the good thing is, when we look at the really high end of the spectrum of these machines that really allow, for instance, iPhones to be made with those really high end little chips or artificial intelligence chips, they have a monopoly there with the EUV machines. There's just no one out there that can do this. This is science in its purest form. If you're interested to see a bit more in-depth review of this, go to my channel, subscribe, and here you see the video, ASML stock, 5 reasons to buy. You will find it there. Have a look at it, and it is a more in-depth review about this. But look at this presentation again. I mean, this is really interesting, right? A record quarterly net bookings of 8.9 billion compared to 8.1 billion before, right? Including 3.8 billion of EUV NA machines, the newest one that are coming here. Earnings per share 4.29, and I believe it was 3.30 something in the last quarter. So this company is really firing on all cylinders. And there was a bit of a worry because of the export rules that America is putting on chip manufacturers. Actually, there's really little impact because ASML explained in their investor relations presentation and when they did the interview with the CEO that there are only few small components that come from China. They have a really strong quality supply chain. So no worries there. I think the real impact would be if it's TSMC and Taiwan. We know that America is big friends with Taiwan, so I don't expect anything there anytime soon. I mean, that they were increasing their backlog was really impressive to me. And if you look here at the total net sales, we're just at 3 quarters now. It's already beating the 2020 sales. And they are expecting 21 billion in revenue by the end of the year. It should be possible because they're expecting a 6 billion something in the next quarter. So I think they will be beating again their own revenue numbers. This is just a powerhouse, guys. But okay, let's go now into the analysis. Let's first look at the dividend safety of ASML. I mean, this can't get any better, right? 94% dividend safety. All the metrics are almost flawless. 14 years of dividend growth. What is also good to know, guys, they just switched to a quarterly dividend payment. It was annual before, €5.50. It is now 1.37 on a quarterly basis. So hey, this is again, if you are looking for a European dividend stock that's paying on a quarterly basis, this might be it, guys. If we then look at the analysis here, because valuation is of course something else, it's currently trading at €460. It was trading around 400 before the earnings announcement, so it just grew 15% this week. Based on these numbers, it just tells you how good the numbers were. What it's showing here is a relatively low yield of 1.2%. So I would say you really buy it for the growth part of the portfolio here. You buy this stock for your children actually to benefit from the dividends, let's say 10, 15 years from now. Of course, we don't know where the chip industry will be in 20 years from now. So there is some risk involved. You really need to think about it from that point of view as well. But the dividend growth rate, remember earnings, dividends, and the return on invested capital, we're talking about 35% because last year they doubled their dividend. EPS growth 32%, and return on invested capital stands at the moment at 41% at a 9% cost of capital. We're talking here about 32% value creation towards us as shareholders. I mean, this is really amazing. Now, if we then look at the fair value that I assigned to this company, it's €535. This means that the company is still clearly undervalued. I'm doing this based on a low cash flow. 6 billion here. It's currently at 8.4 billion, but therefore I've got higher growth numbers. You need to know, if you go to the video that I shared before, it was 20%. I reduced it a little bit due to the news updates that we got from the company, but still from my point of view, it's really undervalued. 15% in the first 5 years still in growth rate should be possible. We had just 35% behind us. So then 12% thereafter, a discount rate of 10% and a multiple of 18. And I believe with such numbers, probably the company will trade at a higher multiple. I think this number is fair. If it is able to do 20% and 12% thereafter, we're talking really about 725 euros. So there's a lot of price appreciation possible in this stock as well. I mean, I love ASML. It will not be a core holding for me on the short term. I need more dividend income in the next 5-6 years. However, I am nibbling into this stock. I own already one share. I wanted to buy more at 375. I was hoping for a bad earnings report because I truly believe in this company, but I'm thinking at least to buy one more share this week just as a token of appreciation to this high quality company. And I also don't want to miss out because who knows if it ever gets back to 400, right? And I believe it's already undervalued right now. So this was an example actually of an IT stock. And if we look at this chart here, IT stocks in general should perform worst. But the thing is, we're talking here about a monopolist. Hence, they have pricing power. This is a booming industry. These are long lead items, heavy capex investments. Clients are typically not delaying this because if they would delay, they are losing competitive power. A good example of that was Intel. That's why they already paid almost 9 billion upfront to ASML to be able to get the newest 0.33 nano machines. So this is the strength of the company. That's why it's really anti-cyclical, and I believe it will continue to do really, really well, unless of course we get new news from ASML. And that's what we do. We always do our own homework after we buy. It's not buy and hold. It's buy and continue to do our homework. But like a company of ASML, just quickly once a quarter, the quarterly earnings report, and you should feel fine. So the third one then is actually an industrial, but for me a consumer staple. And this company is SnapOn. I mean, if you don't know SnapOn, it creates tools, not so much available in Europe, I would say, from what I've seen, mainly available probably in the United States, probably many workers. If you're a worker from the States, let me know if you actually use this equipment. From what I've seen and what I've heard, it seems to be pretty decent stuff. And this company for me, I mean, look at this earnings report here. Net sales were 6.2% up, organic sales 10%. Currency impact, of course, as well, because of strong dollar of 4%. But look at this here then. 16% growth deleted earnings. We're talking about here one of the strongest declines that we have been seeing in the last decade or since the 2009 crisis, right? Really based on fundamentals declines. Yeah, not like the COVID shock that we had, but like just because of the increasing rates and interest rates and everything. And this company is just able to do 16%, guys. 16%. I mean, let that sink in. This is really, really, really strong from this company. And for me, it is really a consumer staple, although it's in the industrial sector, but it behaves like a consumer staple. So for me, again, a top-notch quality company. I'm really glad that one of my followers, Dividend.exe from Sweden, pointed to me at this company like 9 months ago because I really, really love it. But full disclosure, I don't own it yet, but definitely I would like to own it. What's also good to know is we can expect a dividend hike anytime soon, probably in the next 2 weeks, because last year they did it on 4th November, the year before on 6th November. So probably around that date, we will hear a dividend hike. The last one was quite significant with 15%. I hope on something like 10% here. And then this company trades really better, around 3% dividend yield. That's for me a really, really nice yield. Now, if we look at their dividend safety score, then dividend safety score are 79, almost in the very safe category. Again, solid balance sheet here. Look at debt to equity, less than 1%. It's just a pristine balance sheet. Interest coverage of 25. So come on, guys. I mean, almost nothing here. Why didn't it score in the 80s? Because during the last recession, it kept their dividend flat. I mean, I'm okay with these kinds of things. That's why I'm not punishing for them for it. Otherwise, if you probably go to the aristocrat list, it will say 13 or 15, 30 or 14. But in my opinion, it has 25 years dividend growth or remain. And I'm good with that. We know this from European companies. I don't mind conservative management. Over time, this company is just a beast with their dividend growth of 70% over the last 5 years. Come on, guys. Beating inflation, right? Beating inflation. If we look then at this company here from a valuation point of view and such, everything green almost except the dividend yield, a little bit higher, and it will be green fully. What I like again here is that it's really already on the multiple valued nicely, 12%. But remember, we're looking at dividend growth, 70% when we talk about fundamentals, according to the infographic. Earnings growth as well. We see here 12% over the last 5 years. And again, 12% value creation for shareholders because the return on invested capital is way 12% above the cost of capital itself. I mean, I love these kinds of numbers. So if we look at this, from a value point of view, I believe that the fair value is $220 based on a baseline free cash flow of $740. This is the 5-year average. It had some working capital issues this year in the free cash flow, which company didn't, right? So that's why I'm not too harsh on that. It should be favorable again and back to normal next year. If we take a growth rate of 5%, which is much less than the 12% we have seen over the last 5 years, 3% thereafter, and the 10% discount rate and a multiple of 16, we would be talking about a fair value of $221. If we take a little bit higher, 7 and 4% would be 260. But if it's worst, almost flat, 322 over the next decade, right? I don't believe this, guys. But there's a probability there. It will be 187. So I love this company. I have a buy order outstanding at 200. It will be then my first initiating position into this company. I know the dollar is also strong for us, but okay, I can't fight that. Hence, I would definitely buy some SnapOn at $200, guys. Okay, guys, these were the 3 stocks. But before you go, hey, why don't you join me in the conversation? We have an awesome Dividend Talk group. It's related to the podcast that I'm having. I will put the link to the podcast also in the description of this video, together with my buddy Engineer My Freedom. But look, 748 members at the moment, and it's actually quite becoming more and more active. It's already active. We discuss earnings here, like SnapOn that I just showed to you, but also earnings reports that are coming up, and people also asking all kinds of questions. So why don't you join us on the Dividend Talk group and, join the conversation, guys. Having said that, I wish you a lovely remainder of the weekend. Almost done, of course, and see you next time.